Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Good morning, everyone. This is John Darsie, Editor-in-Chief with T3 Live, here for your morning call. So yesterday we got a little bit of rest after a two-day snapback. On Monday we got that big sell-off, as everyone knows, sort of started bringing some anxiety into the market. And then we had a two-day snapback that brought us back towards highs, and a lot of people were cursing themselves for missing a dip and all that type of stuff. Yesterday we rested, and then this morning, what do we get when we walk in? Futures are down about 9 or 10 handles. They've bounced a little bit. They're currently down about 7 or 8 handles, but still it remains a very difficult little range to maneuver for active traders unless you're really trading the extremes of the ranges. If we go to the spider chart right away here, we can see the erratic action that we've had this week. We get Monday, we get this huge sell-off. It looks even worse on the chart because we gapped up significantly that day. And then we had the surprise in the Italian elections with Berlusconi's party having some surprising success. Then we sold off all the way down here, and then people started to sort of push that stuff to the side and not worry so much about the sequester and about the Italian elections. And we got a two-day snapback that was a lot bigger than obviously the bears would have liked. If we go back to the chart, and on Wednesdays when we really had that grind higher back, we erased all those losses. Yesterday was just sort of a day of rest. And then we'll go ahead and take a look at the 5-minute chart of the spiders just to give you an idea of what the futures are looking like pre-market. We were down here as low as around 150.80 in the pre-market. We've bounced a little bit. We'll go back and look at the daily chart and look at that 150.80 level, and that represents the 21-day moving average. So we've talked a lot about the 8 and 21-day moving average as a roadmap for this market, and if a market does break its 8 and 21-day moving average, we look to see how quickly it climbs back above it. And the market was able to quickly this time around climb back above it. But this morning we're testing that 21-day moving average again, which is the last short-term moving average we look to for market composure. So definitely look at that area. If you're looking for a micro level of support or a pivot area, definitely watch that 21-day moving average. And then it almost looks a little bit like our old favorite wedge pattern that's developing. If we go back to the chart, you have ranges are increasing. One thing that's important to note is when ranges increase, we've been talking about this a lot on off the charts and the morning call and price point sheet, whatever products you have. When ranges start to increase and volatility starts to pick up near highs, it's not necessarily a sign to jump all out of the market, but it's a sign for caution, and it's a red flag. It's a sign that institutional selling might be happening at certain points, a sign to lighten up on some longs depending on your time frame. Macro guys have really had nothing to worry about. If you're a short-term guy, now's the time to be more flexible, more nimble. But if we go back, we'll take a look at this wedge pattern that's starting to develop towards the upper range in the SPYs. We get our line tool here. You see the top end of it here, and you could see something sort of happen right about here. We need a period of consolidation after that fast start of 2013, and it would definitely make sense to see the market trade in a little bit of a range up here as we sort of consolidate those gains and get ready for more action. So the big question today is, what stock should we be looking to potentially from the short side and the long side, if depending on whether you're looking to buy the dip or press some shorts on this down open. I think anytime you're trying to play extremes in this market, you haven't been rewarded. After a two-day snapback, you shouldn't really be talking about piling into longs. Yesterday, the morning call, for example, Scott very eloquently stated his opinion that you shouldn't revenge trade and chase stocks after this two-day snapback, given the technical damage we saw on Monday's candle. It's very important not to have that fear of missing out if you get a quick snapback from a sell-off, because, like I said, this increase in volatility near highs is definitely a red flag and a sign of caution. So don't get exuberant on a snapback and don't get over aggressive on a 9-10 handle gap down, which we could see this morning. But a couple stocks that I would, if you're looking to press shorts, that I would look for we'll start with Baidu. This is one that we've been talking about as a weak one in tech on earnings. It gapped down. We talk about the importance of that earnings gap. What did Baidu do? it wasn't able to push into that earnings gap at all. It flagged. You got a nice breakdown from that flag, and then what's it doing again? It's still flagging down here below its 8-day moving average. It sort of bounced into it yesterday, but based on this morning's action, it'll probably get rejected at that level. We'll zoom out a little bit, and you see a major pivot point here on Baidu. So if you, on a micro level, you look at this little flag right here as a potential area to short it. We'll draw our lines. And then you zoom out even further on the daily chart. Get rid of our line tool. You see it's coming into a very long-term crucial area of support. We'll even zoom out to the weekly to get a better picture of it. And you see how far Baidu came in 2010, 2011. And you've seen these wide ranges. You talk about that as a red flag, and Baidu towards highs. And then you got this major pivot level. And if it breaks that level, you could see it down into this cluster of support down as far as the $70 area. That's more of a macro target, but I'm sure momentum guys will be watching this one closely today as it could break that flag. Go back to the daily chart. Another one I'm looking at potentially from the short side is Lululemon. Lululemon, they make a great product. I love Lululemon clothes. It's not just for women. Men can wear Lululemon too. Great material, very, it's expensive, maybe why the stock is so high, but Lululemon is a stock that is looking a little bit dicey to me right now at upper levels. It's one of those momentum darlings that hasn't really broken down yet the way you saw from some stocks like Chipotle and Netflix before this recent bounce, but it's one of those stocks that over the last few years has been a big momentum darling. You look at this huge run it's had, but it's sort of hanging out here at upper levels and looking a little bit dicey, like I said. You have this major level of support that it's tried to sort of break it a couple times in the last week. I guess that's Tuesday that it tried to break below, but it was able to rebound with the market on Wednesday. But I would continue to watch this area of support for potential momentum. I think the first move you'd look for is down somewhere here in the $62 area. You have a little cluster of support here. But then you got these lows that could ultimately be tested around 55, and I really wouldn't be surprised to see Lululemon get down there. We're also going to take a look, I think it's a little bit of taboo sometimes to talk about Apple from the short side, but if you really look at the chart and be honest with yourself, Apple looks like a dead short. You've seen this sell off from above $700 a share ahead of earnings, and then you had earnings confirm that move. Maybe somebody knew something. I would never make that kind of accusation, but if you look at the chart, it confirmed that move. We saw the big gap down, and what do we talk about gaps? How much of it was able to be filled right away? None. It traded down from the gap. It was able to enter it a little bit. It got rejected at this minor support level or minor resistance level here, and then it's traded back down to the lows. This, looks like a dead cat bounce to me. Apple looks like a dead short in this level. Once again, it's a little bit taboo to talk about it like that, and you don't want to press it too hard after a huge sell-off from above $700 a share. But Apple, it looks bearish to me, and on this down open, it's opening lower, and you can see it definitely probe that major short-term support level there, and potentially you got this gap right here from that gap and go back in early 2012. So I think that's a natural level of support for Apple, and I really wouldn't be surprised to see it get down there if we continue to get pressure on the market. We're going to look at a couple other high beta tech stocks as we zoom back in here. We're going to take a look at Google. It's been one of the strongest ones, obviously, that we've been talking about. It's hanging out near highs. You have Google continuing to innovate with their Google glasses and all that type of stuff. We're going to take a look at the 5-minute just to get a look at the action in the pre-market so we can take a look at some levels. It looks like Google's been a little bit all over the map, so I'm not exactly sure where it's going to open pre-market, but you see it sort of trading around that $800 level, which is a psychological level, even though it's not necessarily a huge technical level. But I would watch the 8-day moving average, which is around 795, to see if that gets taken out. We haven't seen Google really lose its 8-day moving average at all this year. You saw a slight close below around here, but it was able to snap back. But you could see a short-term composure change, and it's worth having upper-level stops if the market comes under pressure. And we're going to pivot a little bit now and take a look at the financials. You have the XLF, which showed its really first cracks in the foundation on Monday on that big sell-off. And I think it's very important to understand the dynamics of the financials, and what really moves those stocks is that the European debt crisis has been a huge focus for the market over the last few years, and that's what has really been weighing on the financial stocks. You have a lot of interconnectivity between the world banking, the big banks in the world, and if you see Europe start to crumble, it would have a huge impact on the banks. But we've sort of seen the European debt crisis fall a little bit out of the focus and into the periphery over the last few months. and that has been one of the reasons why the banks have been able to bounce. You look at the XLF here, had that big sell-off on Monday. It was able to bounce. It wasn't able to take back as much of that loss as the market was, which is a little bit of a sign the XLF may need to rest and may not continue to lead exclusively. This morning it's opening lower and will be back below that 8 and 21-day moving average. And I think you probably could look to press the financials a little bit. Normally we look to short weak stocks and weak sectors, but sometimes there's a little bit of a dynamic of the bigger they are, the harder they fall. So it's been so strong for so long, and it gets a little bit fragile at upper levels when you get that type of situation. Then you wait for the price action to confirm it. You don't just short strong stocks on highs. You wait for a little bit of some signs that they're cracking and some signs they're not going to retrace a sell-off like we saw Monday. And then you maybe look to press some shorts. I think Goldman Sachs has been the strongest one in the group, and it's not the one that I would necessarily be looking to short, even though you could say it got rejected by its 8-day moving average as resistance after breaking it on Monday. But the one I would really be looking to short is a Bank of America. Scott has done a really good job of finding very selective long trades in Bank of America, and I think an important point he made yesterday on the StockTwits Q&A is that different banks are appropriate to trade at different times. You have Bank of America at certain times it sets up for nice trades to the long side. At certain times it's Goldman Sachs that leads the market, and JP Morgan. Those are the ones you want to be focusing on. But I think in general, Bank of America is a little bit of a weaker bank, and if I'm going to be looking to short banks on a slight bounce, Bank of America is one of the ones I would be looking at. If we go back to the chart, you see Bank of America wasn't really able to bounce very impressively. It's still below its 8 and 21-day moving average. This $11 support level, which is sort of a prior breakout here out of this mini wedge, and you see it tested that level here, was able to bounce, so that's become a decently significant level of support. And if it does break that level, I think you really could see a pull in back to this little wedge here around 1050, and then I ultimately wouldn't be surprised to see it retest that $10 breakout, which on a macro sense that would be healthy. You see the $10 level was that previous breakout. When you see stocks retest a major breakout level like that, it's not game over for these stocks. It's not the end of the world. It's healthy to see them digest and retest and potentially set up for another move higher. So traders have been sort of clamoring for a pullback and some rests and all that in the market. And then once you get it over the last few days, everyone starts to complain about the volatility and the whippiness and everything like that. Well, you gotta be happy with something. You can't always be grumbling about the market. The market never really makes it easy for us. So if you want volatility, it's here. And take a short-term approach if that's your time frame. And if you're a macro guy, I wouldn't really be worried about anything right now. We're not really testing major support levels. You have the sequester, which is obviously a little bit of a concern, but after Washington gets through their bickering and their childish arguing, hopefully they'll get a compromise done. We can stop obsessing about that in the media. That's about it for the morning call. I think it's important on a day like this to sort of take you want to take a stock-specific approach, but you want to really watch the market to get a clue on which side of the tape you're going to be looking to play. I think the first half hour to an hour of this session are going to be really telling about whether we get more panic due to the sequester and you see people really pile out of longs, or whether this is sort of another opportunity that people take to buy the dip. I'm sort of neutral on that. I wouldn't take a firm stance based on not seeing the opening range in the market, but I think now, as we've talked about plenty of times, is a time to be flexible. Maybe take a contrarian view at each extreme of this range, and maybe look for a wedge pattern develop in the S&P over the next week or so. This has been John Darsie with the Morning Call. We'll see you out on the virtual trading floor.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.